All right, so are you ready to like really level up your trading? Because today we're going to do a deep dive into how institutions trade futures.
Futures, yeah.
The strategies that like hedge funds and those Wall Street giants use.
hmm
And trust me, what they know can make a huge difference in your trading.
For sure. We're going to be moving beyond like basic indicators and really understanding how these big institutions analyze the market.
Okay, so before we get into like the really technical stuff, let's start with the basics.
Yeah.
How is it different thinking like an institution versus how like the average retail trader approaches the market?
Well, one of the biggest differences is just the scale.
Okay.
Institutions are managing tons of money.
Right.
So they really have to focus on volume and order flow and risk management in a way that most retail traders just don't even consider.
So it's not like just finding a hot stock tip and jumping in.
No, not at all.
Okay.
They're looking for signals like within the market itself, like where large orders are being placed and how volume is shifting and how price is reacting at different levels.
So they're not just reacting to the price, but they're kind of trying to anticipate where the market's going to go
Yeah,
based on all these forces, right?
exactly.
Yeah.
And one of the key tools they use for this is what's called multi-time frame analysis.
Multi-time frame analysis. I've heard that before, but
Hmm.
what does that actually mean in practice?
So it means looking at the market from a bunch of different perspectives, not
Cool.
just focusing on like a 5-minute chart, but considering the daily, the weekly, even monthly charts
Okay.
to understand the broader context.
Oh, so you're like zooming out to see the big picture and then zooming
Gosh,
in,
exactly
kind of
that
see the
way.
details.
Yeah, that's a great way to put it.
Okay.
Institutions use those longer time frames to identify the primary trend and then drill down to shorter time frames to pinpoint their entry and exit points.
Interesting.
Yeah.
So you wouldn't just take a trade because it looks good on a 5-minute chart.
Not without considering the context of the longer time frames.
Gotcha.
You want to make sure the overall trend is in your favor before you jump into any like short-term moves.
Okay. That makes a lot of sense.
Yeah.
But what about all these like complex tools we hear about, like footprint charts and cumulative delta? Those sound pretty intimidating to someone just starting out.
Yeah, they might sound intimidating, but they're really just ways of visualizing the data that's already there.
Okay.
And once you understand what they're showing you, it can totally change how you see the market.
All right. I'm intrigued. Can you break those down for us?
Yeah, so let's start with footprint charts.
Okay.
Think of them like a detective's magnifying glass.
Okay.
Instead of fingerprints, they're showing you the footprints of large orders in the market.
Okay.
So each footprint on the chart represents a specific price level, and it shows you the volume of buy and sell orders that were executed at that price.
So if I see a big footprint at a particular price, that means there was a lot of activity there. But what else?
So it's also about the context of that activity.
Okay.
So you can actually see who was more aggressive at that price, the buyers or the sellers.
Mm-hmm.
And that tells you a lot about the potential for future price movement.
Wow. It's like you can see behind the scenes.
Yeah.
Like you can see what's driving the price.
Exactly.
Okay.
And then there's cumulative delta, which is another really powerful tool that institutions use to track buying and selling pressure.
Okay. Is that similar to just looking at volume?
Yeah, it's related to volume, but it goes a little deeper.
Okay.
It tracks the net difference between buy and sell orders over time,
Mm-hmm.
which gives you a more like nuanced understanding of who's really in control.
So it's not just how much is being traded, but who's actually doing the buying and selling.
Precisely.
Interesting.
And what's really interesting is how institutions use cumulative delta to spot potential reversals before they happen.
Wait, so they can see the future.
Not quite. But by analyzing divergences between price and cumulative delta, they can get a sense of when a trend might be losing steam and a reversal is brewing.
Okay, so I'm starting to see how these tools can give you a real advantage.
Mm-hmm.
But wouldn't you need access to like some crazy expensive platform to even see this data?
Actually, a lot of the popular platforms offer these tools.
Oh, okay.
You don't need a Bloomberg terminal to get started.
So these insights are accessible to the average trader.
Absolutely.
That's great.
It's more about understanding how to use the tools and interpret the data.
So this is all fascinating stuff. So we've talked about how to think like an institution using multi-time frame analysis, decoding tools like footprint charts and cumulative delta. It's like we're getting a glimpse behind the curtain of Wall Street.
And we're just scratching the surface.
Right.
There's so much more to explore when it comes to institutional trading strategies.
Okay, I'm ready to dive deeper, but before we do, maybe we could just recap what we've learned so far just to make sure it's all sinking in.
Sounds good. So we started by talking about how institutions approach the market differently, focusing on things like volume order flow and risk management in a way that most retail traders just don't.
Right.
And then we explored how they use multi-time frame analysis to understand the broader context of the market before they make any decisions.
Right. And then we got into like the specialized tools that they use, like the footprint charts and cumulative delta,
Exactly.
to understand the buying and selling pressure.
Mm-hmm.
It's pretty cool how those tools can reveal like those hidden forces driving the market. It's like seeing the Matrix or something.
Yeah, that's a great analogy.
Yeah.
And once you start seeing the market through this lens, you'll never look at it the same way again.
Okay, so we've laid a really solid foundation here.
Yeah.
I'm ready to take it to the next level.
Okay.
What other secrets are you ready to unveil?
Well, let's talk about how institutions use like traditional indicators, but with a twist.
Okay.
Like moving averages, MCD, and RSI, they use them in a much more nuanced way than most retail traders do.
Okay, I'm all ears. So how do they take those classic indicators to the next level?
So instead of just looking for basic buy or sell signals, they're using those indicators to confirm trends, to identify divergences, and to anticipate potential shifts in momentum.
So it's not just following the signals blindly, but understanding what they mean in the bigger picture.
Exactly.
Okay.
They're looking for what we call confluence,
Okay.
multiple indicators aligning to confirm their thesis.
I can see how that would make a big difference
Yeah.
in your trading.
Yeah, and it's not just about the indicators themselves, but how they use them in combination with all the other tools we've been talking about.
Right.
It's about putting all the pieces together to form a complete picture of the market.
Yeah, it's all starting to click for me now. We're
Good.
seeing the market through a whole new lens.
Mm-hmm.
But I have to admit, it's a lot to take in.
It is, but that's the beauty of it, you know?
Yeah.
Learning about institutional trading strategies, it's a journey of continuous discovery.
Right.
And the more you learn, the more you realize there is to learn.
All right, so before we get lost in the weeds here,
Yeah.
maybe we can take a step back and look at another really important element of institutional trading, and that's risk management.
Yes, absolutely. Risk management is something that a lot of retail traders overlook, but it's really the foundation of any successful trading strategy, especially at the institutional level.
Okay, so what makes their approach to risk management so different?
Well, for starters, they're just super disciplined about position sizing.
Okay.
They never risk more than a certain percentage of their capital on any single trade, no matter how confident they are.
So they're not like going all in on one idea.
No, not at all.
Okay.
They know that even the best trades can go against them, so they spread their risk across multiple positions.
Makes sense, but how do they determine like the right position size to begin with?
So they use a combination of factors:
Okay.
their overall account size, their risk tolerance, and the volatility of the market that they're trading.
So it's like a tailored approach based on their own circumstances.
Exactly. There's no one-size-fits-all formula.
Right.
Yeah.
Okay, but even with the right position size, they still need a way to protect themselves from losses. Right.
Yeah, that's where stop-loss orders come in.
Oh, the good old stop loss, every trader's best friend.
Indeed, but again, institutions approach stop-loss orders a little differently.
Okay.
They don't just place them arbitrarily.
hmm
They use their analysis to determine like the most logical place to exit a trade if it starts to go against them.
So it's more about minimizing losses, not just avoiding them altogether.
Precisely.
Interesting.
They're constantly evaluating the risk-reward ratio of their trades and adjusting their stops accordingly.
This is all gold. But before we get too deep in the technical weeds,
Yeah.
let's take a step back and remind ourselves why we're exploring these institutional strategies in the first place.
Right. It's all about leveling up your trading. By understanding how institutions approach the market, you can gain insights that most retail traders just never even consider.
Right, it's like getting to look behind the curtain and see how the wizard is pulling the levers.
Exactly. And once you see how the game is really played, you can start making more informed decisions and improve your trading results.
I love that it's not about copying institutions blindly, but learning from their approach
Right.
and then adapting it to your own trading style.
Absolutely. It's about taking the best of their strategies and making them your own.
Okay, so we've covered a lot of ground already. We've talked about multi-time frame analysis, volume and order flow, footprint charts, cumulative delta, and the importance of risk management. It's like we're getting a crash course in institutional trading.
Yeah, and we're just getting started. There's so much more to explore.
Oh, I'm excited to dive even deeper. But before we do, how about we switch gears for a moment and talk about one specific tool that institutions use to gain an edge?
Okay, sounds good.
Okay, so we touched on volume profile, but I think it deserves a closer look.
Yeah.
It seems like it's like a core part of how institutions identify trading opportunities.
It is. Volume profile is like a map of the market's activity.
Okay.
It shows you where price has spent the most time and where the biggest battles between buyers and sellers have taken place.
So it's not just about seeing how much volume was traded, but where that volume was concentrated.
Exactly. And those high volume areas, which we call points of control or POCs,
Okay.
can be super valuable for identifying potential support and resistance levels.
So institutions use those points of control to figure out where the price is likely to bounce or break.
That's one way they use it. They also look for price to break through or reject those POCs because that can signal a shift in momentum and the start of a new trend.
So it's like they're using volume profile to anticipate where the market is headed.
That's the idea.
Wow.
They're looking for clues within the volume data to understand those underlying forces that are driving price action.
Okay, so how do they actually use volume profile to find those trading opportunities?
Okay.
Can you give us an example?
Sure. So let's say you're looking at a chart and you see a really clear high volume area that acted as support in the past.
Okay.
Now the price is approaching that level again.
So we're watching to see if the price bounces off that support level.
Exactly. But institutions are also watching closely to see how the price behaves as it approaches that level.
Okay.
Are there signs of buying pressure increasing?
Okay.
Are the footprints showing aggressive buyers stepping in?
So it's not just about the level itself, but like the activity around that level.
Precisely.
Okay.
If the price breaks through that high volume area easily and continues moving lower, it suggests that the buyers are no longer interested in defending that level.
So that's a bearish signal.
Right. But if the price stalls at that high volume area and starts to bounce, it's a bullish signal that the buyers are still defending that level.
Gotcha. So it's all about reading the clues within the volume profile to kind of see who's winning, the buyers or the sellers.
Absolutely. And by understanding that balance, you can start to anticipate potential breakouts or reversals.
This is making a lot of sense. It's like we're putting on like a new pair of glasses and seeing the market in a whole new light.
That's the power of learning about these institutional trading strategies. It can totally change your perspective and give you the tools to trade with more confidence and clarity.
All right, so we've covered a lot of ground in this first part of our deep dive. We've talked about thinking like an institution, multi-time frame analysis, footprint charts, cumulative delta, and we even started to explore the power of volume profile.
Yep. We've laid a solid foundation for understanding how institutions approach the market and the tools that they use to gain an edge.
But there's still so much more to uncover.
Oh, there is.
What other secrets are you ready to share?
Well, in the next part of our deep dive, we'll delve a little bit deeper into how institutions use momentum and volatility to their advantage.
Okay.
And explore some of the specific trading setups that they employ to capitalize on market opportunities.
Sounds fascinating. I can't wait to hear more.
Looking forward to it.
Okay, so we're back and ready for more on these institutional trading strategies.
Yeah.
Last time we were talking about how institutions use tools like footprint charts and volume profile to get a deeper understanding of the market.
We were looking at how they use those tools to identify potential support and resistance levels.
Yeah.
And to anticipate shifts in momentum.
Exactly. But I'm curious, how do they actually use that information to make trading decisions?
Yeah.
Do they have specific setups that they're looking for? Or is it more of an art than a science?
It's a bit of both, actually.
Okay.
They have frameworks and strategies, but they also adapt based on the specific market conditions and the context.
So it's not about just blindly following a set of rules, but understanding the principles behind those rules and applying them in a flexible way.
That's a great way to put it.
Oh?
They're not just reacting to price, they're thinking strategically about where the market is headed and positioning themselves accordingly.
So what are some of those key principles that they use to make those trading decisions?
Well, one of the most important is understanding momentum.
Okay.
Institutions are always looking for signs of increasing or decreasing momentum
Okay.
to kind of get a sense of the strength of a trend.
So they're not just looking at whether the price is going up or down, but how quickly and decisively it's moving.
Exactly. And they use a variety of tools to measure that momentum, including some of the traditional indicators that you might already be familiar with.
Okay, so we're talking about things like moving averages,
Yep.
MACD, RSI.
All part of the equation.
Okay.
But again, they use them in a more nuanced way than a lot of retail traders do.
Can you give us an example? Like, how would an institution use a moving average differently?
Sure, let's take the 200-day moving average, for example,
Okay.
which is a really popular indicator for identifying long-term trends.
A lot of retail traders might just buy when the price crosses above the 200-day moving average
Right.
and then sell when it crosses below.
Yeah, like the basic strategy.
Right, but an institution wouldn't necessarily just jump in based on that crossover alone.
Okay.
They'd want to see confirmation from other indicators
Right.
and their overall market analysis.
So they're looking at like the context behind it,
Exactly.
not just the price action.
They're asking, is the volume supporting this move?
Yeah.
Is the cumulative delta showing strong buying pressure?
Mm-hmm.
Are there any divergences between price and momentum indicators?
So it's about putting all the pieces together to get a complete picture of that momentum.
That's right.
Okay.
And it's not just about entering trades, but also managing those trades effectively.
Right.
Institutions are constantly evaluating like the momentum of their positions and adjusting their stops and targets accordingly.
Yeah, I can see how that would be crucial for protecting profits and minimizing losses.
Now, you mentioned divergences. Can you elaborate on that a little bit? Like, what are divergences
Right.
and how do institutions use them?
Sure. So a divergence happens when the price action and a momentum indicator are telling different stories.
Okay.
For example, the price might be making higher highs, but the mass CD is making lower highs.
So even though the price looks strong on the surface,
Yeah,
the momentum might be weakening.
exactly. And that can be a warning sign that the trend is starting to lose steam
Okay.
and a reversal might be coming.
Wow. It's like they're reading between the lines of the market's language.
That's a great way to think about it.
Yeah.
They're looking for these subtle clues that a lot of traders just miss.
So momentum is obviously a key principle for these institutions. What else do they focus on when they're making their trading decisions?
Another really crucial element is volatility.
Okay.
A lot of retail traders are afraid of volatility,
Right.
but institutions see it as an opportunity.
Really? But isn't volatility unpredictable and risky?
It can be, but institutions have strategies for managing that risk and even profiting from it.
Okay.
They understand that volatility creates big price swings, and big price swings mean potential for big profits.
Okay, I see your point.
Yeah.
But how do they measure volatility?
Yeah.
And how do they use that information to their advantage?
One of the tools they use is called the average true range, or ATR,
Okay.
which measures the average range of price movement over a specific period.
So if ATR is high, it means the market is volatile.
Exactly.
And if it's low, it's relatively calm.
Right, and institutions use this information to adjust their trading strategies.
Okay.
For example, if the ATR is high, they might widen their stop-loss orders
Okay.
to give their trades more room to breathe.
So they're not getting stopped out prematurely
Exactly.
during those wild swings.
They're letting the market do its thing without getting shaken out of their positions.
That's smart. But how do they actually use ATR to find trading opportunities?
So they look for periods of expansion and contraction in the APR. When the ATR is expanding, it means volatility is increasing, which can signal the start of a new trend
Okay.
or an acceleration of an existing trend.
So they might look to enter trades as that volatility is picking up.
Exactly. They're riding that wave of increasing momentum.
Okay.
And conversely, when the ATR is contracting, it means volatility is decreasing,
Right.
which can signal a potential trend change
Gotcha.
or a period of consolidation.
So they might like take profits or tighten their stops when the volatility starts to fade?
That's right. They're adapting to the changing market conditions.
This is fascinating. It's like they're surfing the waves of volatility instead of getting crushed by them.
That's a great way to put it, and that's the key to successful trading. To not fear volatility,
Yeah.
but to understand it and use it to your advantage.
Okay, so we've talked about how institutions approach momentum and volatility. But what about specific trading setups? Are there any particular patterns or formations that they look for?
Absolutely. One classic setup that they use pretty often is called a breakout trade.
Breakout trades, those are popular among retail traders too.
They are, but institutions have a much more sophisticated approach to identifying and executing breakout trades.
Okay, so how do they do it differently?
Well, first of all, they're not just looking for any random price breakout.
Okay.
They're focusing on breakouts from significant levels,
Okay.
like previous highs or lows, key support and resistance zones,
Right.
or important moving averages.
So they're not just chasing any price move,
Right.
but looking for breakouts that actually have a higher probability of working out.
Exactly, and they're not just relying on price action alone.
Right.
They're also looking for confirmation from volume,
Yeah.
order flow, and momentum indicators
Right.
to make sure there's real conviction behind that move.
So they're looking for that confluence of factors to really validate that signal.
That's right. They want to see a surge in volume,
Uh-huh.
aggressive buying pressure on the footprint charts,
Right.
and momentum indicators confirming the strength of the move.
So they're really doing their homework
They are.
before jumping into a breakout.
Yeah.
But what about managing those trades? Like, how do they protect themselves if the breakout fails?
Right. So that's where risk management comes in.
Okay.
And it's really a critical part of any successful trading strategy,
Mm-hmm.
especially for breakout trades.
So they're not just setting it and forgetting it?
Not at all.
Okay.
They're actively managing their positions, adjusting their stops and targets as the trade develops.
Can you give us an example of how they might manage a breakout trade?
Sure. Let's say an institution has identified a potential breakout trade from a key resistance level.
Okay.
They've seen the volume building up, cumulative delta showing strong buying pressure,
Right.
momentum indicators confirming the strength of the move.
Sounds like they're ready to pounce.
They are, but they also have a plan in place if that breakout fails. They've set a stop-loss order just below that breakout point to limit their losses if the price reverses.
So they're not letting emotions dictate their actions.
Exactly. They have a predetermined exit strategy in place before they even enter that trade.
So they're prepared for both scenarios, like a successful breakout or a failed breakout.
That's right. And that's really the key to consistent profitability in trading. It's not about always being right,
Yeah.
but it's about managing your risk effectively
Right.
and letting your winners run.
This is making a lot of sense, but I'm curious, what other types of trading setups do institutions use besides breakout trades?
Another popular setup is called a mean reversion trade.
Mean reversion, what's that all about?
So mean reversion is the idea that prices tend to revert back to their average or mean over time.
Okay.
It's based on this principle that markets often overshoot in both directions, creating opportunities to buy when the price is below its average
Okay.
and sell when it's above its average.
So it's kind of like a pendulum swinging back and forth.
That's a good analogy.
Yeah.
And institutions use various tools to identify those overextensions
Right.
and potential mean reversion opportunities.
Like what kind of tools are they using?
So they use a variety of indicators, including Bollinger Bands,
Mm-hmm.
oscillators like the RSI,
Okay.
even statistical models to determine when the price has moved too far from its mean.
So they're not just eyeballing it.
Not at all. They're using quantitative methods to identify those potential turning points.
So they're using these tools to spot opportunities where, like, the market's gotten ahead of itself
Exactly.
and it's likely to correct.
Precisely. And by understanding those mean reversion principles,
Yeah.
you can start to identify trading setups with a higher probability of success.
Okay, so we've covered a lot of ground in this second part of our deep dive.
We have.
We've explored how institutions use momentum and volatility to their advantage.
Mhm.
And we've looked at two specific trading setups, breakout trades and mean reversion trades.
We've also seen how they combine technical analysis with risk management
Right.
to create a comprehensive trading approach.
But there's still more to uncover, right?
There is. In the final part of our deep dive, we'll delve into the psychological aspects of institutional trading,
Okay.
and we'll explore some of the more advanced tools and techniques they use to gain an edge in the market.
Sounds like we got a lot to look forward to. I can't wait. Okay, so we're back for the final part of our deep dive into how institutions trade.
Yeah, we've covered a lot of ground.
We have.
It's been a lot of fun.
It has, but I feel like there's still more to uncover.
Oh, yeah, for sure.
What other secrets are you ready to share?
Well, let's talk about something that's often overlooked,
Okay.
but absolutely crucial for success in trading, especially at the institutional level, and that is psychology.
Psychology. I thought we were talking about like charts and indicators.
Yeah, that's all important, of course.
Right.
But it's only half the battle.
Yeah.
The other half is really mastering your mindset and your emotions.
So you're saying that even with all the right tools and strategies, you can still mess things up if you don't have the right mindset.
Absolutely. In fact, I'd say psychology is even more important than technical analysis.
Wow.
You can have the best trading setup in the world,
Mm-hmm.
but if you let fear or greed take over,
Right.
you're going to make bad decisions.
Okay, that makes sense.
Yeah.
But what does like trading psychology actually mean?
Yeah.
Like, what are some of the key things that institutions focus on?
One of the most important is discipline.
Okay.
Institutions have really strict rules and processes in place,
Mm-hmm.
and they stick to those rules no matter what.
Okay.
They don't let emotions like cloud their judgment
Right.
or deviate from their plan.
So it's about removing like that impulsivity, not just like chasing trades based on a gut feeling.
Exactly.
Okay.
They have a system and they trust that system.
Right.
They don't second guess themselves or let fear or greed drive their decisions.
Makes sense. It's about having a plan and actually executing it. Okay. Another key aspect of trading psychology is managing risk.
Okay.
Institutions are obsessed with protecting their capital.
Makes sense.
They know that even the best traders are wrong sometimes.
Right.
So they have strict risk management protocols in place to make sure they're not losing too much.
So we've talked about stop loss orders and position sizing,
Mm-hmm.
but are there other ways that institutions manage risk from a psychological perspective?
Yeah, one important technique is compartmentalization.
Compartmentalization, what's that?
So it's basically mentally separating each trade from the others.
Okay.
So if one trade goes against them,
Right.
it doesn't affect their mindset on the next trade.
So it's like having a mental reset button.
Yeah, that's a good way to think about it.
Yeah.
They stay focused on the process and don't get caught up in the emotional roller coaster of winning and losing.
Okay, so discipline and risk management are crucial.
Mm-hmm.
What else is there when it comes to trading psychology?
Another really important factor is patience.
Institutions are willing to wait for the right opportunity.
Mm-hmm.
They don't force trades
Right.
or chase the market.
So they're not just jumping into any trade that looks good
Oh, not at all.
on the surface.
They're very selectively choosing their battles and only entering trades that meet their specific criteria.
So it's all about waiting for the setups
Yeah,
that have the highest probability of success.
exactly. And they're comfortable sitting on the sidelines
Yeah.
if they don't see any compelling opportunities.
That takes a lot of discipline.
It does, but that patience is really what allows them to make consistent profits over the long term.
This is really interesting. I'm starting to see how this psychology part of it
Mm-hmm.
can be just as important
Yeah.
as mastering the technical analysis.
Absolutely. I'd say it's even more important.
Wow.
Technical analysis can give you the edge,
Right.
but psychology is what allows you to actually execute that strategy consistently
Okay.
and avoid making those costly mistakes.
So we've talked about discipline, risk management, and patience.
Mm.
Are there any other, like, psychological traits that institutions look for in their traders?
One more I would add is adaptability.
Okay.
Markets are constantly changing,
Right.
and successful traders need to be able to change with them.
So it's not about finding that one magic formula
Yeah,
and sticking to it.
definitely not. You have to evolve
Sure.
with the market.
So they're constantly learning and refining their approach.
That's right. They're always looking for ways to improve and to adapt to those ever-changing market conditions.
This is all incredibly valuable. It's like we're getting a glimpse inside the minds of these elite traders.
And by understanding their approach to psychology, you can start to develop those same mental habits
Right.
and discipline that lead to success.
Okay, so we've covered a lot of ground in terms of like the psychology of institutional trading.
Mhm.
But before we wrap things up here, I'm curious, are there any other like advanced tools or techniques
Yeah.
that institutions use that we haven't talked about yet?
Well, one area that's becoming increasingly important is algorithmic trading,
Okay.
also known as algo trading.
Algo trading, that sounds pretty high tech. What is that?
So it's basically using computer programs to automate trading decisions
Okay.
based on predefined rules and parameters.
So instead of like placing trades manually,
Yeah,
you're letting a computer do it for you.
that's the idea. And it's becoming more and more common at the institutional level
Okay.
because it lets them execute trades faster and more efficiently
Than a human can.
than a human can. Exactly.
I can see how that would be a huge advantage.
It is, especially in a fast-moving market.
Right.
Algo trading can also help to reduce the risk of like human error
Right.
and emotional decision-making.
So it's not just about speed and efficiency, but
Yeah.
it's about taking the emotion out of it.
Exactly. And as technology continues to improve,
Yeah.
algo trading is only going to become more sophisticated and more prevalent in the markets.
Like the future of trading.
It-
But is that something that like retail traders can even access?
It used to be exclusive to institutions, but now there are platforms and tools available
Oh, okay.
that let retail traders create and implement their own basic algorithms.
So it's becoming more accessible.
It is, and while it's still a relatively advanced area of trading,
Hmm.
it's definitely something that anyone can learn and benefit from.
This has been amazing. We've explored so much about how these institutions approach the market,
Mm-hmm.
from their technical analysis and trading setups
Yeah,
to their risk management and psychology.
absolutely.
And we even got into like the cutting edge of algo trading,
Mm-hmm.
which is crazy to think about. It's like
Yeah,
shaping the future of the markets.
it is.
I feel like we've gained so much knowledge and insight from this. It's
Yeah.
like we got a backstage pass to the world of institutional trading.
I hope that this deep dive has given you the knowledge and the tools that you need to really level up your own trading.
It definitely has. It's been
Good.
an amazing experience. I'm excited to take everything we've talked about and start applying it to my own trading.
That's the spirit. Remember, it's a journey of continuous learning and improvement.
Yeah.
The market's always evolving, and you should be too.
Well said. And to all of our listeners out there, thank you for joining us on this incredible deep dive into institutional trading strategies.
Yeah, thanks for listening.
We hope you found it valuable and insightful.
Mm-hmm.
Until next time, happy trading.